Welcome to another IFRS session brought to you by AARO Academy, where we make complex accounting standards easy to understand. In this session, we'll simplify IFRS 12, the standard outlining disclosure requirements for interests in other entities. Our focus today will be on the disclosure requirements related to subsidiaries. But why is it important to disclose interests in other entities? These disclosures provide clarity on risks and relationships, helping stakeholders trust and interpret financial statements. What is an interest in another entity? It means having financial involvement that impacts returns based on the entity's performance, through equity, debt instruments, or agreements like guarantees or credit support. So where does IFRS 12 apply? This standard applies to entities with 1. Subsidiaries, controlled entities. 2. Joint arrangements, joint ventures or operations. 3. Associates, greater than 20% and less than 50% interest. 4. Unconsolidated structured entities, not governed by voting rights. 5. Held for sale interests under IFRS 5. Today we'll zoom in on subsidiary disclosure requirements. A subsidiary is an entity controlled by another entity. It can be wholly or partially owned with non-controlling interests, NCI, representing shareholders who do not have control. IFRS 10 handles consolidation. IFRS 12 defines what you must disclose about subsidiaries. What must entities report? Let's explore the key areas. Entities must disclose the critical judgments and assumptions they made when assessing control over another entity. This is especially important in complex situations where 1. An entity holds more than 50% of voting rights but does not have control due to other factors. 2. An entity holds less than 50% of voting rights but still exerts control through other mechanisms, such as contractual agreements or dominant influence over key decisions. 3. The entity acts as either a principal or an agent in an arrangement that delegates power. These disclosures should explain the basis of such judgments, any changes made to the assumptions during the reporting period, and the implications for group reporting. For example, the group determined that it controls entity X, despite holding only 40% of voting rights due to contractual agreements that grant it power over significant operational decisions. This assessment was reviewed during the reporting period and remains unchanged. Entities are required to disclose the structure of the group to help users understand its composition and ownership dynamics. This includes key details for each subsidiary, such as its name, principal place of business, percentage ownership, and, if different, the proportion of voting rights. For large or complex groups, aggregated disclosures may suffice, provided the details for major subsidiaries or subgroups are clearly outlined. Be mindful of local regulations, which may demand more specific disclosures, such as listing all subsidiaries, regardless of materiality. For example, the group comprises 15 subsidiaries, of which 5 are material to the financial statements. The ownership percentages for these subsidiaries range from 51% to 100%. A detailed breakdown of these subsidiaries, including their principal locations and ownership structures, is provided in Note 15 of the financial statements. For partially owned subsidiaries, entities must disclose NCIs to provide transparency on their role in the group. This includes ownership percentages and differences in voting rights, if applicable, profit or loss allocated to NCIs during the reporting period, dividends paid to NCIs. For subsidiaries with significant NCIs, additional detailed disclosures are required, such as A. The subsidiary's name and principal place of business. B. Ownership and voting rights percentages held by NCIs. C. Profit or loss and accumulated NCI amounts. D. Summarized financial information about the subsidiary's assets, liabilities, profit or loss, and cash flows presented before intercompany eliminations. Disclosing the group composition and non-controlling interest held can be displayed in a tabular format such as this. If a subsidiary's financial statements are prepared as of a date different from the group's consolidated financial statements, the entity must disclose 1. The subsidiary's reporting period end date. 2. The reason for the difference, such as local regulatory requirements. Example: Entity Z's reporting period ends on November 30th, as required by local regulations. Adjustments have been made to account for significant transactions occurring between this date and the group's year-end on December 31st. Subsidiaries are required to disclose information related to consolidated structured entities. A structured entity is designed so that control isn't determined by voting rights, but by contractual arrangements directing key activities. Examples include securitization vehicles, special purpose vehicles, SPVs, asset-backed financing, and certain investment funds. Structured entities may be consolidated if the reporting entity has control. For consolidated structured entities, the following disclosures are required. 1. Contractual obligations. Conditions of any contracts that obligate the entity or its subsidiaries to provide financial support, including events that might trigger potential losses. For example, liquidity agreements or credit rating triggers. 2. Voluntary support. Any financial support provided without contractual obligation, specifying the amount, type, and reasons for providing the support. 3. Future intentions. Disclosure of any current plans to provide financial or other support. Example disclosure. NI Financing Services entered into a liquidity support agreement with XYZ securitization vehicle to provide financial support if cash flows from mortgage assets fell below 75% of projections for 2 consecutive months. In 2024, NI Financing Services voluntarily provided $5 million to stabilize the SPV due to market volatility, which reduced the value of the underlying assets. This voluntary support was not mandated by any contractual obligation. As of the reporting date, NI Financing Services evaluated the current market conditions and asset values and intends to provide up to $3 million in additional support during the next fiscal year. Entities must disclose any changes in ownership interests in subsidiaries, which may occur in 2 main scenarios. 1. Changes without losing control. When an entity's ownership interest in a subsidiary changes but control is retained, the change is accounted for as an equity transaction. This means it does not affect profit or loss or the carrying amounts of assets, including goodwill, and liabilities. The entity must disclose: A. The nature of the ownership change. B. The impact of the ownership change on equity attributable to the parent's owners. 2. Changes where control is lost. When an entity loses control over a subsidiary due to a disposal or other event, the entity must: A. De-recognise the subsidiary's assets, liabilities, and any related goodwill. B. Recognise any retained interest in the former subsidiary at fair value. C. Calculate and disclose the resulting gain or loss, specifying the portion of the gain or loss attributable to measuring the retained interest, the line items in the financial statements where the gain or loss is recognised. Thank you for watching. IFRS 12 sets essential disclosure requirements for interests in other entities, ensuring financial transparency and informed decision-making. Want to deepen your knowledge? AARO Academy offers group accounting training focused on subsidiary reporting and consolidation. Join our IFRS group accounting training for hands-on learning with practical case studies.
Additionally, visit our website to book a demo of the AARO consolidation software designed to simplify the consolidation process, minimize errors, and ensure compliance. Don't forget to like and subscribe to our YouTube channel for more content on ESG, IFRS, and financial reporting. Follow AARO Academy on social media to stay updated on new events and learning opportunities.